Hi, and welcome to this lecture. We're going to be talking about cost volume profit analysis, which we'll use our fixed and variable costs to perform. And then we'll learn how to make a contribution margin income statement, which is going to allow us to easily compute break-even and a target profit. Let's talk about cost volume profit analysis. This is the examination of the relationships among selling prices, sales and production volume, costs, expenses, and profits. So how can we use this? Well, it can help us to look and see what will the impact be if we change our selling prices on profits. In other words, if we increase our selling price, will our profit go up? Well, of course, that really, you have to answer another question before you can answer that. If I increase my selling price, will my volume go down? That is, if I'm charging more, will I sell less? Well, probably, but using cost volume profit analysis, I can still see what my impact on profit will be at various levels of sales volume. So that's how this will help us determine whether or not an increase in sales price will ultimately be good for profits or bad for profits. And we can do the same thing based on all sorts of other assumptions. Basically, how will our profits be affected if we lower some of our costs, if we increase sales volume but don't increase sales prices, and what mix of products should we sell? Should we sell all of one thing, or should we sell a variety, and how much of each of the variety? And this can help us to choose our marketing strategies. So that is how cost volume profit analysis can help managers make decisions. Let's first learn how to calculate contribution margin. It is sales minus variable costs. So sales can usually be computed by your selling price times your quantity that you are going to sell minus the variable cost, which is the variable cost per unit times the quantity that you're going to sell. So why is this important? Well, if you have enough contribution margin to cover fixed costs, then after that, any additional contribution margin will actually increase your income from operations. That is, after you cover fixed costs, every amount over that is going to increase your profits. Here's some data for Lambert Inc. They have sales of 50,000 units, and they sell it at $20 per unit. So in a moment, you'll see we're going to say sales times sales price, sales volume times sales price. That gives you your total sales. And then variable cost per unit is $12. So then you'll say 12 times the number that you plan to sell. And then you've got to have enough to cover your fixed costs. So let's look at the next slide and see what it looks like. This is the contribution margin income statement, and it's called that because we get a subtotal called contribution margin. So again, our sales were the number that we plan to sell times the unit selling price. So 1 million is our sales. Variable costs are the number that we plan to sell times our unit variable costs, which are $12. So that's 600,000. Now we can compute our contribution margin, which is just sales minus variable costs. So contribution margin is 400,000. We need enough to cover our fixed costs, which luckily we have because our fixed costs are 300,000. And so income from operations is $100,000. That is contribution margin minus fixed costs gives us our income from operations, or our profit from operations. There's another useful bit of information that we can get from this, and that is the contribution margin ratio. Sometimes it's called the profit volume ratio, and it's going to indicate the percentage of each sales dollar available to cover fixed costs and to provide income from operations. So the way we compute that is going to be contribution margin, which was 400,000 in the last slide, divided by sales, which was 1 million. So when we divide 400,000 by a million, we get 40%. So our contribution margin ratio is 40%. So why do we care about this? Well, it can help managers see information very quickly. Let's look at this example. The contribution margin ratio is useful when the increase or decrease in sales volume is measured in sales dollars. So in this case, the change in sales dollars multiplied by the contribution margin ratio will equal the change in income from operations. So in other words, if they want to quickly see what the impact will be on income from operations, they can simply multiply it and see what that impact will be. So what you can take from this slide is that the change in income from operations, that's what we want to know, is equal to the change in sales dollars times the contribution margin ratio. So let's say, for example, that we knew that Lambert thought that they could add 80,000 in sales because they were going to sell an additional 4,000 units, and say they were doing a new advertising campaign, and that's how they came up with that. They said if we advertise, then we can sell 4,000 more units, which will be $80,000 in sales. Well, if we multiply that 80,000 by 40%, which we know is our contribution margin ratio, we can quickly see what our profit increase will be. We could say, hey, if we do that, we'll make 32,000 more in profits. So that can help a business make decisions about advertising and other things. All right, on the next slide, we'll show you how to prove that that was correct. Here's the proof that that worked. So if we just do a contribution margin income statement at the new level, so we increased our sales, it used to be $1 million, but now we said, hey, we're not going to just sell $1 million, we're going to sell 1,080,000. So we're going to put that number in. Our variable costs went up just by the 4,000 units, so now it's the old amount plus the additional 4,000 units. And so our new contribution margin is 432,000. Fixed costs are still 300,000. And earlier we were only going to make 100,000, but now we can see that we're making 132,000, which means that our profit did increase by $32,000. So instead of having to do this income statement with the new numbers, we were able to quickly see how much our profit would increase just by knowing how much our sales may increase. Sometimes it's more helpful to know the unit contribution margin. So the unit contribution margin is the unit selling price, which was $20, minus the unit variable cost, which is $12. So the unit contribution margin here would be the 20 minus 12, which is $8. And you will see in a few minutes how we can use the unit contribution margin as well. The unit contribution margin is most useful when the increase or decrease in sales volume is measured in sales units. In this case, the change in sales volume multiplied by that unit contribution margin equals the change in income from operations. So if we assume that Lambert sales could be increased by 15,000 units, then we will multiply 15,000 by the unit contribution margin ratio, which was $8, and we will see that we expect a profit of $120,000. Let's look at the next slide to prove it. Jumping down to the bottom, we used to have 100,000 in profit. Now we have 220, so we can see that it did in fact increase by 120. And we do this by multiplying out our numbers with the new number, and we can see that our profit did increase by that 120,000 that we computed. Here's something else that we can easily compute. It's called break-even point. So the break-even point is the level of operations that our company's revenue and expenses are equal. So if revenues and expenses are equal, we actually have zero profit, and that's what break-even is, that level where we have zero profit. Now, of course, we don't want zero profit, but it's a good idea to know, hey, what's the lowest level we can go before we're losing money? So that would be your break-even point. It's computed like this. Fixed cost is the numerator, and unit contribution margin, in our last slide it was $8, right, goes on bottom. So you're going to divide fixed costs by unit contribution margin. This slide is just a visual of what break-even means. It is where revenues exactly equal costs. In other words, where revenues minus costs gives you $0. Assume the following data for Baker Corporation. Baker Corporation has fixed costs of $90,000, unit selling price of $25, unit variable cost of $15, which gives you unit selling price minus unit variable cost gives you unit contribution margin. So we're going to say fixed costs of $90,000 divided by unit contribution margin of $10, and we find out that if they sell 9,000 units, they will break even. We're going to calculate it out on a contribution margin income statement on the next slide, and you'll see that if they sell 9,000 units, they will in fact make $0. That's your break even. As we said, they sold 9,000, so we multiply that by the unit selling price. Variable cost, they sell 9,000, multiply that by the unit variable cost. Contribution margin then is 90,000. Fixed costs were given at 90,000, so 90,000 minus 90,000 gave you $0 from income from operations. So what we can say is that if they sell 9,000 units, that's their break even in units, then they will make 0 profit. If instead of wanting to know how many units we need to sell, if we would rather calculate how much sales dollars we need, then we can just change our formula slightly and come up with the break even in sales dollars rather than the break even in sales units. So all we're going to do is change the denominator to have the word ratio on it. So fixed cost divided by the contribution margin ratio will give us our break even in sales dollars. So first, let's just do a reminder of how to calculate that contribution margin ratio. It's going to be your contribution margin, the unit contribution margin, divided by unit selling price. So here, 10 divided by 25 equals 40%. So this is our contribution margin ratio. So to calculate break even in sales dollars, we have fixed costs, 90,000, divided by contribution margin ratio, 40%. And we can see that if we sell $225,000 of sales, then we will break even. So the only thing that's different here is instead of telling us how many units to sell, it is the number of units times the selling price, which is the sales dollars. It'll be more clear on the next slide. Let me show you. So here we have the same calculation, but as we can see that it was in fact $225,000 worth of sales that helped us to break even. Let's talk about the effect of fixed costs. We learned that fixed costs don't change in total with the level of activity. However, that doesn't mean that fixed costs don't change. We might have a new advertising campaign and increase how much we spend on advertising. Advertising is a fixed cost, and if we do that, of course, that fixed cost will increase. We may have a change in property tax rates or give some raises to our supervisors, and so those salaries, which are a fixed cost, will increase. So let's talk about how changes in fixed costs affect the break-even point. If you have an increase in fixed costs, then the increase will make your break-even point go up. So an increase in fixed costs, increase the break-even point. In other words, you have to sell more to still break even. The decrease in fixed costs will do the opposite. It will decrease the break-even point. So if we laid off some supervisors, then our break-even point would decrease because our fixed costs decreased. Here's a visual on the effect of change in fixed costs on break-even point. If fixed costs increase, then break-even also increased. If fixed costs decrease, then break-even decreases. Assume that Bishop Company is evaluating a proposal to budget an additional $100,000 for advertising. The data for Bishop Company is as follows. So they have a unit selling price, which stays the same under the current and the proposal. I have a unit variable cost that also stays the same. That gives them a unit contribution margin that's the same. And then fixed cost is proposed to go up from $600,000 up to $700,000. Bishop's break-even point before the additional advertising of $100,000 was computed as follows. So it was fixed costs of $600,000 divided by the unit contribution margin, which was $20. So to break even, they needed to sell $30,000. If they increase their fixed costs by $100,000 for doing this new advertising, then we would say $700,000 divided by 20, and we would find out that they need to sell 35,000 units. So in order to still break even, they would need to sell an additional 5,000 units to break even under the proposal. Let's do the same thing now with unit variable costs. We know that unit variable costs do not change with changes in level of activity. However, unit variable costs may be affected by other factors, such as changes in the cost per unit of direct materials. Let's say wood goes up in cost, or changes in the wage rate for direct labor, or changes in the sales commission paid to salespeople. Changes in unit variable costs affect the break-even point as follows. Increases in unit variable costs increase the break-even, and decreases in unit variable costs decrease the break-even point. So we'll look at it in a visual as well. This looks just the same as fixed costs because it affects break-even just the same as fixed costs. If unit variable cost increases, then break-even increases. If unit variable decreases, then break-even decreases. Let's see how this can help us make decisions. Assume that Park Company is evaluating a proposal to pay an additional 2% commissions on sales to its salespeople as an incentive to increase sales. The data for Park is as follows. So the unit selling price, what they're going to charge their customers, stays the same, but unit variable cost is what increases. So it goes from 145 up to 150. This makes unit contribution margin decrease because the variable cost went up, so it made unit contribution margin decrease, and fixed costs will stay the same. So before the proposal, their break-even was 8,000 units, and if they pay more to their sales commissions, then their break-even becomes 8,400. So they have to sell an additional 400 units to break even under the new sales commission proposal. So we've looked at what fixed cost changes do. We've looked at what variable cost changes do. Now let's see what changes in selling price does. So if we charge our customers more, what happens? So changes in the unit selling price affect the break-even point. By increases in unit selling price will decrease break-even because you're charging more, so it makes you be able to sell less. And decreases in unit selling price increases the break-even point. This is our visual, and as you can see, now we have an inverse relationship. So if unit selling price goes up, break-even goes down. If unit selling price goes down, break-even goes up. Let's look at an example of how this can help a manager make a decision. Assume that Graham Company is evaluating a proposal to increase the unit selling price of a product from $50 to $60. The data for Graham follows. So they used to charge $50 per unit, and now they're going to charge their customers a proposed amount of $60. Unit variable cost stays the same, and unit contribution margin is going to go up because the selling price went up. Fixed costs stay the same at $600,000. Break even before they increase selling price used to be 30,000 units. And if we run the numbers again, we can see that now, if they increase the selling price, then they only have to sell 20,000. So break even went down, and they can sell 10,000 less units and still break even. This is a summary of the effects of fixed costs, unit variable costs, and selling price on break even. So as we said, fixed costs have a positive relationship to break even. That is, if they go up, break even goes up. If they go down, break even goes down. Same thing with unit variable costs. They go up, break even goes up. They go down, break even goes down. But unit selling price has an inverse relationship. If we charge our customers more, our break even goes down. We don't have to sell as many to break even. And if we charge less per unit, in other words, we discount our whatever it is that we're selling, then break even goes up. We have to sell even more to still break even. As you know, we don't actually want to just break even. We want to have a profit. So we can use the exact same formula, but plug in a target profit in the numerator, just add it to our fixed costs, and then we can figure out how much do we need to sell for a target profit. So here's the formula. It looks the exact same as break even, but on the numerator, we add in our target profit. In other words, we don't want to just cover our fixed costs. We want to cover our fixed costs plus a target profit. In doing this, we can figure out how many we need to sell to get that target profit. We're given some data for Waltham Company. We have fixed costs, and we want a target profit of 100,000. So by adding our fixed costs to our target profit and still dividing by unit contribution margin, we can see that we need to sell 10,000 units to make a $100,000 profit. The next slide will prove that it worked. Plugging in the 10,000 units times the amount that we charge per unit, and the 10,000 units times the amount that we pay for our variable costs, we can see that our contribution margin was $300,000. Subtract out fixed costs, and we did in fact come up with an income of $100,000, which was our target profit. That is the amount that we wanted to make, and we did. So using that target profit calculation, we found out that we needed to sell 10,000 units, and when we input it into the contribution margin income statement, we can see that it did in fact yield $100,000 in profits. If we wanted our calculation to tell us how much we needed to make in sales instead of telling us how many units to sell, we did the exact same thing, but our denominator is contribution margin ratio, and it will give us our number in sales dollars instead of sales units. So fixed cost plus target profit divided by contribution margin ratio. It's the same thing, but this is telling us how much in sales dollars we need to make that $100,000 in profit. So here's the same slide as before, but now let's focus on the $750,000. When we use contribution margin ratio, we were given the $750,000 instead of given the 10,000 units. Either way, that's how much we need to have a profit of $100,000. So let me know if you have any questions. Thanks.